Your gold dropped hard. Your silver dropped even harder. Screens turned red, headlines turned dramatic, and panic spread fast. But while most investors were staring at falling prices, something much bigger was happening quietly behind the scenes. Something that explains far more about the future of precious metals than any single day of market chaos ever could. Most people think last week was just another crash, another routine market correction. But what if I told you that the real story has almost nothing to do with short-term price swings? What if the movements in gold and silver were only symptoms of a much deeper global shift that has been building for years? Right now, the world financial system is changing in ways most Americans have not fully understood yet. And at the center of that change is one massive trend. China is steadily walking away from U.S. government debt and replacing it with hard assets. Official Treasury data shows a pattern that is impossible to ignore. China once held more than $1 trillion in U.S. bonds. Today, that number is dramatically lower, sitting at levels not seen since before the global financial crisis. Hundreds of billions of dollars have quietly left the American bond market over the past decade. This is not random selling. This is not market timing. This is not panic. It is policy. When a nation slowly reduces its exposure to another country's debt year after year, it is making a strategic decision about the future. And China's decision is becoming clearer with every passing month. At the exact same time that China has been selling treasuries, it has been doing something very different with its money. Instead of holding more dollars, it has been buying more gold. Month after month, without interruption, China's central bank has added to its gold reserves. Even when prices surged to record highs, they kept buying. Even when volatility increased, they kept buying. Even when Western investors hesitated, they kept buying. That tells you everything you need to know about their long-term view. Governments do not chase short-term trades. Central banks do not gamble. When a country as large as China steadily accumulates gold for more than a year straight, it is because they see something fundamental changing in the global system. And they are not alone. Around the world, central banks have been buying gold at historic rates. Demand from governments has doubled compared to the years before 2022. More gold is being purchased by official institutions today than at almost any point in modern history. Ask yourself a simple question. If gold was really finished, if the bull market was truly over, why would so many governments continue accumulating it at these levels? Why would major financial institutions still be raising long-term price targets even after a brutal sell-off? Markets can panic. Prices can swing wildly, but central bank behavior rarely lies. Now let's talk about silver, because silver tells an even more dramatic story. For years, the silver market has been in a structural supply deficit. More silver is being used by industries than is being mined from the ground. Solar panels, electronics, electric vehicles, medical equipment, and advanced technologies all depend on silver in ways most people never think about. Unlike gold, which is primarily held as wealth, silver is consumed. Once it goes into a solar panel or a circuit board, it does not come back to the market. And mining supply cannot simply be turned on overnight. New mines take a decade or more to develop. That creates a slow-motion squeeze between rising demand and limited supply. Meanwhile, inventory levels in major silver vaults have been falling for years. Physical metal is leaving the system faster than it is being replaced. Yet at the same time, enormous amounts of paper silver continue to trade on exchanges, creating the illusion of endless supply. This is why silver prices can crash so violently in the short term. The paper market is heavily leveraged and extremely sensitive to forced selling. When margin calls hit and traders are forced to sell, prices can collapse even if nothing has changed in the real physical world. A price chart can look terrible while the underlying fundamentals remain incredibly strong. That is exactly what we just witnessed. The crash did not close the supply deficit. It did not increase mining output. It did not reduce industrial demand. It did not refill depleted inventories. It simply shook out leveraged traders who were overexposed to short-term movements. Now step back and look at the bigger picture again. China is reducing exposure to U.S. debt. China is increasing exposure to gold. China is tightening control over key resources. And more countries are slowly looking for ways to trade outside the dollar system. This is not about 1 week of market volatility. This is about a long-term global rebalancing of financial power. For decades, the US dollar has enjoyed a unique position at the very center of the global economic system. It has been the world's primary reserve currency, the backbone of international trade, and the asset most governments relied on in times of uncertainty. That system is not disappearing overnight, but it is slowly becoming less dominant than it once was. As alternatives grow, as new payment systems develop, and as geopolitical tensions rise, more nations are asking whether it makes sense to keep the majority of their wealth tied to one country's debt. Gold answers that question in a way no bond ever can. Gold cannot be printed. Gold cannot be sanctioned. Gold cannot be frozen. Gold does not depend on any government's promises. That is why it is becoming more important again in a world that feels increasingly unstable. So where does all of this leave the average investor? It means you need to separate noise from reality. Short-term price crashes feel terrifying. They always do. But long-term trends are built on fundamentals. Look at what central banks are doing, not what day traders are doing. Look at physical demand, not paper speculation. Look at multi-year data, not one brutal trading session. History shows the same pattern over and over again. Precious metals experience violent corrections. Investors declare the bull market dead, and then years later prices move to new highs once the temporary fear fades. The underlying forces driving gold and silver today did not begin last month, and they will not end because of one crash. Debt levels continue to rise around the world. Central banks continue to diversify reserves. Industrial demand for silver continues to expand. Geopolitical uncertainty continues to grow. Those realities are not going away. This does not mean prices will move straight up from here. Markets are emotional and unpredictable in the short term. Volatility is part of the game. Anyone involved in silver must be prepared for wild swings. But the long-term story remains intact. A financial system overloaded with debt eventually seeks stability. A world divided by politics eventually seeks neutral assets. And neutral assets have always meant precious metals. What happened last week was not the end of that story. It was simply another chapter in a much larger transformation that is still unfolding. The real question is not whether there will be more volatility. There always will be in markets like these. The real question is whether you understand the forces driving this market beyond the daily headlines. Because while most people focus on crashes, the smartest money in the world is focused on positioning for what comes after them. And right now, that positioning is very clear. Central banks are buying, governments are diversifying, supply constraints are tightening, and the global financial order is slowly shifting. Those trends do not reverse because of fear or temporary panic. They reverse only when the fundamentals change, and so far, they haven't. If you follow the data instead of the noise, you see a very different picture than the one flashing across trading screens. You see a world gradually preparing for a future where hard assets matter more, not less. That is the story behind the crash. That is the story most people missed. And that is the story that will shape the next decade far more than any single day in the market. Stay focused on the long view. Stay informed. And remember that the biggest moves in financial history are rarely obvious in the moment they begin. Real trends develop quietly, long before headlines catch up. The changes happening in global finance today are slow but powerful. Understanding them gives you an advantage that most investors never take the time to build. And in markets like these, knowledge and patience are often more valuable than speed or emotion.